Arctic Star Exploration, operated by a team of proven mine finders, is focused on diamonds in Finland and the Northwest Territories of Canada. Work programs are underway in Finland and Canada. Arctic Star trades on the TSX Venture Exchange symbol ADD, on Frankfurt symbol 82A1, and the OTCQB symbol ASDZF. Please visit our website arcticstar.ca or call us at 604-689-1799.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
Thanks for having me back, Jim.
Ross, a listener sent this question. We heard Ross say that increasing the 30-year amortization would have no impact on the market, but together with lower interest rates, could this goose the spring market?
Yeah, so interesting question, and I know it's one that probably a lot of the listeners have heard pontificated about over the last while. First of all, your spring market for first-time buyers is already over. So when we're talking about increasing the amortization to 30 years, this has generally been in reference to first-time buyers as a way for them to enter the housing market. Well, what I'll tell your listeners is that in each provincial market across the country, those buyers' share of sales does not happen in a higher percentage in the spring. First-time buyers, in this particular part of the cycle, take place in the fall of the previous year. One of the reasons that we don't measure housing markets on a calendar year is specifically for this reason. The buyers enter the market at certain periods of time, and their share of sales impacts the average selling price. It impacts house price illusion. So that would be the very first comment I would have when someone says, could this goose the spring market? Any sign of an increase in activity of first-time buyers in the spring, of course, would be even farther falling average selling prices. So that would always be some way that the listeners could cross-check about what I'm saying here to see what we're saying is true. So 30-year amortization will have no impact on the housing market this spring. I think what this particular listener should understand is that when we talk about changing the amortization in 2019, this is totally different than had we changed amortization in any other year in the past. There have been so many levers pulled since the last time Flaherty changed amortizations, dropping them from the 30 to the 25 years, that all of those different levers that have been pulled are going to have impacted the infrastructure in a different manner. That means the change caused by the increase in the amortization to 30 years will be far less today than what it was even a short 2 years ago. It is also going to impact each housing market differently. The irony in the whole discussion, really, Jim, is what cities are going to be most benefited from an increase in the amortization? And that would be Toronto and Vancouver. So the way that the infrastructure is set up today, when you increase amortization limits, and if the home buyers accept these longer amortizations, the two cities which will be negatively impacted, meaning housing prices are going to go up because of a increase in the length of the amortization period, would be Vancouver first and in Toronto second. So any move to increase maximum amortization length will cause house prices in Vancouver and Toronto over a short period to go up. That said, you're not going to see that till almost a year from now. So all of the propaganda and all of the talk that's out there in the housing market about how this is going to change the market will not be seen. And the government will be going into an election without seeing any changes the stakeholders may have told them to expect to see. It's not going to happen. I think the biggest thing for our listeners to think about is the sheer magnitude, the sheer size of a housing market. A small lever is not going to have a change be recorded in the market. I mean, if we go back and we just look at the 2013 period to 2016 in Vancouver and 2017 in Ontario, that was a long, long period of time before those peak prices were being talked about in the newspapers. The sheer size, the force that has to go into a housing market, force to us means capital. The amount of capital that has to go into a housing market to reach those kind of peaks over such a long period of time, 4 years, the 4 years we're talking about here. It is something that it's just not something that's possible to repeat. And I really think that's what we need to think about when we hear about the question is asked, is this going to speed up the spring market? The simple answer is no.
We'll have more with Ross Kay right after this.
Avon Resources Limited is a gold exploration company with significant projects in British Columbia, Saskatchewan, and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the pink symbol ABN-AF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
Media recognition from Bloomberg, Reuters, recycling trade publications. Patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome back. We're speaking with Ross Kay. Ross, the slowing economy, slowing housing market, and dropping home prices were forecast by you on this show a long time ago. Today, we're hearing that recommendations are being made for the federal budget. What would your number one suggestion be to Bill Morneau, especially when it comes to housing?
Well, I mean, that's where we stay focused. We stay focused on housing and household consumption, home ownership wealth. And this is something that, Mr. Morneau has to come to grips with. Every politician has to come to grips with. The Bank of Canada has to come to grips with. The OSFI has to come to grips with. And even regular old Canadians have to come to grips with. All we have heard about is how a record debt-to-income ratios have been recorded in Canada. At the same time, we have a net wealth accumulation that has exceeded anything in our history. Canadians are now, on paper, wealthier than they have been at any time in their history. This is not a coincidence that mortgage debt and net wealth are both peaking at the same time. It's not a coincidence. It's simply a function of a housing market. You cannot have rising house prices without rising mortgage debt. It is impossible. The two go hand in hand. So Mr. Morneau, when he's looking at housing and he's thinking about how can I stimulate the housing market, what he's basically saying is, how can I get Canadians to take on more debt? You're not going to hear those words appear coming out of the mouth of a politician or an economist, a bank, a realtor, an academic. But that is simply the truth. House prices cannot go up unless Canadians become more indebted. That is simply the way a housing market functions. Deal with it. It's reality. Net wealth, Canadians are richer today than they ever have been in their history. But at the same time, they have more mortgage debt than they ever have in their history. The Canadian housing market is a $6 trillion asset class. It's almost 3 times what the stock market is. Certainly over 2 times what the stock market is, even after housing correction. So this is really what the politicians are faced with. If I'm Mr. Morneau, my choices are this. Am I going to let housing debt decrease, which means falling house prices? Or am I going to ask Canadians to take on more debt and have to get rising house prices going into the election? Now, again, he can't change things around that quick, so it's really irrelevant. But he can put policies in place that 2 to 3 years later can have a negative consequence on our economy because of the impact on mortgage debt. In other words, if we have a whole bunch more mortgage debt, we have less money to spend on other things. So my number one suggestion to Bill Morneau on the housing file is going to be something different than you have heard everywhere else in Canada today. It has never been talked about the Canadian Real Estate Association, banks, economists, academics, everybody who thinks they know what's going on in a housing market. It hasn't been talked about by any of them. And that's the tax-free savings account. My number one suggestion to Bill Morneau to rescue young home buyers and benefit the entire economy is to return the tax-free savings account to what the previous government had committed to doing prior to the Liberals getting elected. I personally believe the best thing that Bill Morneau can do for the housing market right now is to increase your yearly contributions to your tax-free savings account up to $10,000. Better than that, I would say that he should immediately tell all Canadians we are going to add an extra $50,000 limit to the maximum limit every Canadian can contribute to their TFSA. Well, Ross, what does that have to do? How is that going to make houses more affordable to first-time buyers? Well, first of all, what it's going to do, it's going to force them to have a discussion about where they're going to spend their money. Where are they going to save their money? How are they going to save it? You would see an overwhelming press attack by the financial advisors, the wealth managers in the world, in Canada, coming out telling first-time buyers why now they should invest in TFSA versus a house. It would be a balanced discussion would take place. The TFSA also, for existing homeowners, as we said on the show, it is your friend now. Your parents never had a TFSA to offset some of your home equity. Today you now have a TFSA account where you can diversify your home equity. That is something that is not being discussed. This TFSA. So the number one suggestion I would have with Bill Morneau to improve affordability of houses, to make the lives of all Canadians better, to better protect us long term in our wealth building strategies, is to make the TFSA substantially larger than what it is today. Increase the limits. Increase the limits back to what the previous government was going to do. Or come up with your own answer to how big of a TFSA bottom line you're going to allow Canadians to carry.
Ross, it certainly would make the down payment a lot more affordable, wouldn't it?
Well, that's the second part. Now, bang on, Jim. So this is the second part of what I would ask Mr. Morneau to do. I would ask Mr. Morneau to allow any Canadian to give themselves a mortgage. I would allow the TFSA to be a mortgage holder for me purchasing a property. I would allow me, my TFSA, to hold a mortgage for me as high as 100% financing. I would allow myself to pay myself the going 5-year posted rate. That means today, if I have a TFSA, I would pay myself 5.34% annual rate of return on my TFSA. If I'm holding a mortgage, for the sake of the argument, of a down payment, or the full amount of the amount of cash that I have in my TFSA. I would do that because there's no risk. Canadians repay their mortgage debt. If I'm holding my own mortgage, even the ridiculously low foreclosure rate that the history of Canada has had, it's going to be even lower for those people who do that. Now, I would encourage Mr. Morneau to talk to experts out there in the field of financial advisory and wealth management area. Don't believe me. Go talk to the guys that are experts out there. You can go talk to a Hilliard Macbeth. Go talk to a Garth Turner. Go talk to the people who are dealing with clients every day over decades and ask them how they could implement the TFSA in this manner. I would not increase amortization. I would not lobby the OSFI to change B20. I would not do anything that would stimulate house prices in any way today or over the next 3-year window. That's what I would do if I was Bill Morneau in the budget.
We'll have more with Ross Kay right after this.
Hi, I'm Douglas Mason, President and CEO of Rainy Mountain Royalty Corp., RMO, on the TSX Venture Exchange. Rainy Mountain Royalty Corp. is a Canadian-based mineral exploration project generator. The company currently holds multiple property interests in Ontario with joint venture partners and is seeking further joint venture partners for other drill-ready properties in our portfolio. For more information, please visit our website at rmroyalty.com or call me at 604-922-2030.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
Welcome back. We're speaking with Ross Kay. Ross, you were bang on when you picked the peak for the Canadian housing markets for both Vancouver and Toronto. Do you have any idea when we're going to see the bottom of these prices?
Okay, so that is a far more complicated calculation. And the reason I say that, Jim, is that the peak of the market, as the politicians are pulling their levers, they're putting in a spec tax, they're putting in a vacant home tax, they're changing the amortization. Bank of Canada is changing the interest rates. The OSFI is putting in B20. All of these levers are constantly moving. Each time one of these levers move, it changes what the peak was going to be. We know how much mortgage debt is going to be peaked out at, but we don't know exactly how big that mortgage debt can become until we look at the last lever that's being pulled. When we look at what the last lever was pulled, then we have a forecast for when the market is going to change. Now, on the way down, you can't do that. We know right now, by our own metrics, that the average selling price in Canada is sustainable about at $365,000. So let your listeners understand what I'm saying. The levers that are all pulled as they exist today, including the current interest rate charged by the Bank of Canada through the banks, the B20 rule, the current property taxes in the major municipal cities of Canada, because that's a factor. That's another lever that never gets discussed. All of those levers, as they exist today, record about a $365,000 average selling price in the nation of Canada, across the nation. Okay? So that means a balanced sales mix. That means all of those levers remaining unchanged until the market reaches its bottom. That would be 365. Okay, now we got to remember at the peak prices were around the 510 mark. So that is your correcting. As inflation goes on with each passing year, then you've got to add 1.5% to 2% on that bottom line price, because inflation is another lever that needs to be pulled. So when we're talking about the bottom of the market, I can give you what the bottom is today. And that is if things don't change, if things are left exactly as they are today. But you and I both know, Jim, that isn't going to happen. Because if that is what's happened, the recession that we have called on this show, that we are saying we're in right now, would be unbelievable how bad it is. So we do not see that happening. The Bank of Canada has already fallen for the interest rate trap we've described on this show 2 years ago. The Bank of Canada's hands are tied. They can't raise rates because if they raise rates, net wealth of the nation falls. If net wealth of the nation falls, household consumption falls, the economy falls, and the government falls. These are simply the realities of economies that survive on household consumption. There's nothing bad with this about that. It just means that is the reality of what's going on. Deal with it. Your listeners, everybody talks about the housing market, and everybody talks about how crazy it's been. So let your listeners understand this. Ontario, peak to peak. So from the peak in 1989 till the peak in 2017, the peak to peak price, the average annual gain was 4.34%. 4.34%. That is over that entire length of time. Peak to peak was 4.34%. It is not the 30%. How is that, how did they get these 30% gains when over that entire period, it's only averaged 4.34%? It's because they're measuring different things when they're bragging about a 30% gain to get people to go out and book a whole bunch of mortgage debt. It's not the truth. It's representing a housing market in a way it should never be represented to consumers. What consumers should be told is, in Ontario, from the peak of 1990 to the peak of 2018 or 2017, the housing market increased an average annual 4.34%. And then people also have to be told this. The average house that was selling in 2018 is not the average house that was selling in 1990. It is a totally different average house. You wouldn't even recognize that house. That house now has taller ceilings, has a smaller building lot, has more garage space, more bedroom space, fancier bathrooms, higher interior ceilings than what the average house from 1990 was. So not only did housing prices only increase that amount, the average house changed drastically. What remains in effect is house price illusion. And house price illusion, which is how you can go to the bank today and borrow money on your Ontario home, receiving a 4.34% annual rate of return from 1990, is house price illusion. When there's 10 houses listed for sale in your street, house price illusion is out the window. Reality hits home. So that's what I would make the comment when we're talking about a housing market. It is nonsense when we hear the academics from UBC, SFU, Queen's, University of Toronto, University of Western, coming out here making asinine comments about house prices. The truth of the matter, the average purchase price, you notice I've changed my words, I'm not using selling price. in Ontario has increased an average of 4.34%. The average home has increased. The quality of the home has increased during that period of time too. All you can expect to do is for your house to maintain its inflation-adjusted place in the housing stock. That's it. So, peak to peak, 4.34%, the entire province of Ontario, over a staggering 28 years, or 27 years, excuse me. Or that's 20, yeah. And when we're talking about the bottom of the market, the bottom of the market will not be the same when we get there, because governments, politicians, bankers, economists cannot keep their hands off the housing market. They all think they have the answer. They all want to pull their own lever. They're not looking what the other five guys are doing or five girls are doing with the levers that they hold. The levers are all being pulled differently at different periods of time in different parts of the country, and that culminates in the bottom price of $365,000.
Ross, last weekend we heard a story about Vancouver mansions being leased out at seemingly ridiculously low rents. Do you think this is really happening?
I would say to your listeners, Jim, go back to our old shows. You've got them archived on Howe Street, and find out where we told you that there was a way to get away with the speculation tax. We said we had a strategy within 10 minutes of that policy being released where we could get away with the speculation tax. Well, you're seeing it enacted right now with the other taxes that they have out there. Yes, I believe this is 100% true, and I believe you would be an idiot as the owner of a, they're calling them mansions now, mansion rentals, mansion in Vancouver. I mean, these would not be mansions, folks, if you went down to Texas or Washington. The houses they're calling mansions are not mansions anywhere else in the world. They're just executive class homes. These mansion rentals, where people are getting them for unbelievable, like $1,000, $2,000 a month rent. Yeah, I believe that is 100% true, because by utilizing a house fitter, which is the policy that we mentioned years ago here on the show. So again, people can go back and check the records. It laid this out in full. The reason why you're seeing this, and this is not improving the housing stock, people. So, a couple of people may get a really great deal on a rent, but that is not going to change the housing stock situation in Vancouver. All it's going to do is let the wealthiest people who own these houses pay less tax legally by looking for loopholes in the policy. The reason why a politician is not qualified to create a taxation policy on housing is because they don't look at it from the perspective as how it can be attacked. Let's do this the simplest way possible. We'll look at two instances for the end of the show here, Jim. The seemingly innocent $37,000 interest-free mortgage loan the BC Liberals instituted in 2017. It caused massive damage to your housing stock, house prices, and the financial lives of families for the next 25 years. It immediately boosted your average selling price because people were given basically $37,000 more to spend. It was passed up through the sales chain, and it resulted in an overall increase in the housing market in 2017. When it was removed in 2018, boom, it was removed, and the opposite happened. So now you're back to the start of you're back to about the start of 2015 now in the Vancouver housing market, when you're looking at how the levers are pulled. When governments bring policies in, they need to look at how it can be attacked. So we're talking in the city of Toronto right now about their new property tax, and they're talking about holding property tax, I think, at 2.2% gain. The city of New York City right now, Cuomo is out there saying he wants it in legislation that property taxes in New York City don't go up more than 2% a year. They want it enshrined in stone. Well, you know what, folks? If the property taxes don't go up, your housing prices are going to go up. It's the nature of the infrastructure. The infrastructure is designed to accommodate property taxes. People don't understand that if you buy a $1 million house in Toronto, or you buy a $1 million house in Windsor, you have to pay an extra $6,000 a year in Windsor on property taxes. That means the banks, the government, CMHC, will qualify you to spend $6,000 a year less on your mortgage. It makes buying the $1 million house that much more problematic. You need to have a higher income to buy a $1 million house in Windsor than you do in the city of Toronto or the city of Vancouver. I mean, the difference between Calgary and Vancouver is almost 300% in property taxes. I think it's 265% is the difference. It is staggering, the difference in property taxes for a $1 million house in Calgary versus Vancouver. That is what these politicians don't understand. They listen to the stakeholders who say, we can't pay an extra $100 or an extra $200 a year in property taxes. What they don't hear is, well, if we don't charge $200, housing prices are going to go up to make up the difference, which is exactly why Vancouver and Toronto are the two highest priced cities in the country, because you have the lowest property taxes. It makes the home equity pyramid in your local city higher in Vancouver and Toronto than everywhere else in Canada. And that's what this McMansion, Vancouver mansions are ridiculously low rents are. Yes, they have instituted speculation tax, vacant home tax, foreign buyer tax, all with flawed legislation that left loopholes for the wise home buyer, foreign buyer, to manipulate the taxation policies. So yes, I believe this story is 100% true, and I would argue you would have to almost be an idiot not to enact this format. The financial reward for doing it is that you're going to offset almost all of that tax. Well, it's going to even be better. Not only are you going to offset the tax, you're probably going to get your property taxes paid for you by the tenant that you put in there who's taking care of your house. Your insurance on the property is probably going to be lower because it's not a vacant home. Your maintenance repairs in the property, as soon as something's broken, you're going to be notified in it. You can rush in and get that repaired. You don't have to wait till the damage has been done, and a month later, someone calls you up and says, "Hey, by the way, your roof is caved in because there was a small leak in the plywood got soaked and then caved in." That's what people need to understand and need to challenge their governments on. They come up with these great ideas, these great policies, but they don't look at how can it be attacked. The thing that I learned all the years that I was involved selling real estate is that I always had to look how I could change. If I changed something, it would allow a competitor to attack me. If I signed back an offer and I changed one word in the offer, would that allow my competitor to attack my client, getting an advantage over my client? Could I change that word so it worked to my advantage? Politicians need to approach policy in the exact same way. Whether it's Bill Morneau being pressured to increase amortizations to 30 years, to reduce B20 for trade-up buyers, or it's the politicians in Vancouver applying a speculation tax, a vacant home tax. You have to sit back and say, hey, can you tell me how this policy is going to be attacked? Because I can assure you it's going to be attacked. And you're seeing it right now with these ridiculously low rents in Vancouver mansions. Someone is attacking the policy and putting all that cash back into their own pocket.
Ross, thank you so much for being on the show.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. You're listening to HowStreet.com radio. Find us on Twitter at HowStreet, our YouTube channel, Talk Digital Network. If you have questions for Ross or any of our other guests, you can send them to info@HowStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.